committee will come to order. This is a subcommittee on TARP, financial services, and bailouts of public and private programs. Our hearing is entitled, How Roadblocks in Public Markets Prevent Job Creation on Main Street. It's a tradition of this subcommittee to begin with reading of the Oversight and Government Reform's mission statement. The Oversight Committee mission statement. We exist to secure two fundamental principles. First, Americans have a right to know that the money Washington takes from them is well spent. And second, Americans deserve an efficient, effective government that works for them. Our duty on the Oversight and Government Reform Committee is to protect these rights. Our solemn responsibility is to hold government accountable to taxpayers because taxpayers have a right to know what they get from their government. We will work tirelessly in partnership with citizen watchdogs to deliver the facts to the American people and bring genuine reform to the federal bureaucracy. This is a mission statement of the Oversight and Government Reform Committee. With that, I'll recognize myself for 5 minutes for an opening statement. Over 2 years into our economic recovery, America's labor and capital markets continue to face unprecedented challenges. Tens of millions of Americans remain unemployed or underemployed. Economic growth is anemic, and small business continues to struggle to access capital, all of which exist despite an endless number of government initiatives. Recently, our subcommittee examined barriers to small business capital formation, particularly focusing on the pre-IPO market. We heard from market participants and experts who explain the repercussions that outdated SEC regulations have on the formation of startup companies. I'm proud to say that earlier this month, the House passed with broad bipartisan support, which is often rare in Washington, and right now exceedingly rare. We passed several pieces of legislation to roll back these out-of-date and burdensome regulations. Now the next move goes to the United States Senate, where we hope that they'll take positive action. Today's subcommittee hearing takes the next step of examining the life of small or medium-sized businesses, this time in the post-IPO world. While some might associate the IPO market with people becoming overnight billionaires or ringing the bell at the New York Stock Exchange, the reality, or the bell at NASDAQ, the reality is that the health of our nation's IPO market is a signal of its economic growth, innovation, and job creation. Businesses use the capital they raise through an IPO to grow and expand, which means investing and hiring. In fact, over 90% of jobs created by a company are done after it goes public. That's important to note. This is not about the founders putting money in their pockets. It's about giving the company the capital it needs to grow and expand and innovate. Recognizing today's dismal unemployment rate and job numbers, it's no surprise that America's IPO market is suffering. Experts point to market structure and liquidity issues for small and medium-sized companies as a primary reason. For one, the rapid increase in high-frequency trading has directed money toward the established liquidity of the higher-cap companies. This trend has discouraged the kind of attention to startup companies used to garner from investors who used to target them and other small businesses that showed promise of hidden value. Another mentioned item is the abrupt reduction in equity research. Even if investors are intent on finding a diamond in the rough, the lack of information discourages this effort. These market realities and others are why we have invited two of the world's major stock exchanges, the New York Stock Exchange and NASDAQ, to explain the importance of liquidity for small-cap companies and what can be done to strengthen the U.S. IPO market. Our focus is not to reverse market expansion or efficiencies. Instead, our aim is to understand why small to medium-sized companies have second thoughts about going public and the influence that hesitation has on our economy and job creation. With small companies out to fend for themselves in the public markets, experts and academics have suggested the formation of agreements between companies and brokers or even exchanges to create a market in the issuer's security. Such agreements would allow small companies the ability to produce an orderly, liquid market for their stocks that is observed for many household brands. As the saying goes, liquidity begets liquidity. Research has shown that these agreements already permitted overseas have led to a positive influence on liquidity for small public companies. However, like most new ideas, such direct agreements require a change in regulation, this time by both FINRA and the SEC. Today is an opportunity to learn the purpose and effects of these regulations and where there is room for improvement. Orderly markets are one of our nation's greatest strengths. Providing capital, access to businesses, and choice to investors is obviously at the heart of this. In the midst of our slow recovery, it's imperative that we continue to improve our markets to spur innovation and job creation. I'm interested to hear from both our witnesses in both exchanges today about the challenges our small public companies face and what can be done to fortify our post-IPO world. I appreciate their attendance and I look forward to their testimony. And with that, I recognize the ranking member, Mr. Quigley of Illinois, for 5 minutes.
Thank you, Mr. Chairman. Today's hearing will examine how roadblocks in public markets prevent job creation on Main Street. It will focus on how newer and smaller publicly traded companies encounter problems accessing capital from U.S. equity markets. The stock of smaller publicly traded companies often suffers lower trading liquidity. This means that small companies often cannot offer enough shares at prices that are acceptable to buyers, or that companies cannot sell their shares quickly enough. Small publicly traded companies do not have brand name recognition and often have difficulties attracting investors. Some suggest that the U.S. market structure itself is a roadblock for small companies. In a statement prepared for a joint CFTC-SEC Advisory Committee on Emerging Regulatory Issues meeting, David Wild, former Vice Chairman of NASDAQ, stated, "The stock market structure today is disastrous for the vast majority of small capitalization stocks with asymmetrical order books. Who is there to create liquidity for the small capitalization stock? The answer is often no one." I think it is important that our examination seeks to answer why no one is there to create liquidity for small capitalization stock. I also believe we should be innovative in finding ways to create liquidity for small cap stock in the U.S. to ensure equity markets are competitive and attractive for both issuers and investors. Improving small publicly traded companies' access to capital will contribute to the growth of these companies and their ability to create jobs. Any solutions we explore today must also permit our U.S. markets to function effectively and help ensure investor confidence in U.S. markets. However, while I favor bold action in bringing capital to American businesses, we must not sacrifice investor protection. Only a couple years ago, in 2008, we witnessed how inadequate financial oversight led to fraud, recklessness, unscrupulous behavior, and manipulation in the market, which caused the greatest financial crisis since the Great Depression. That is precisely why Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, to reform the U.S. financial regulatory system and to address the lack of accountability for Wall Street firms that caused the crisis or helped cause the crisis. Mr. Chairman, I thank you for holding this important hearing, and I look forward to the testimony of our two witnesses. And I yield back.
I thank the ranking member, and the full committee chairman has joined us and has requested 2 minutes, and the chairman is recognized for 2 minutes.
I thank you, Chairman, and I thank you for holding this important hearing. Your leadership in this area has been essential, whether it's public companies reforming the mistakes made under Dodd-Frank, including the Data Act and other essential reforms that were never included in that act. As we all know, Bernie Madoff succeeded in the largest Ponzi scheme in American history because of an absence of transparency that could have easily made not just a few smart people who pushed the SEC on behalf of the investors, but the entire public very aware that he was trading in nothing. So I know that the work you're doing there, along with crowdfunding, is essential. And you know, I join with Mr. Quigley on the need to have small cap funds not become orphans. But at the same time, it's very clear that a great many companies should be allowed to have a broad group of sophisticated investors without the need for full public scrutiny and full public access. Often institutional investors, knowledgeable and with their own resources, given an audited financial statement, will make a wiser, more informed, and larger contribution. So there are many ways in which we can help reform the capital markets. I share with Mr. Quigley the need to make sure we never again have a meltdown, and that's where the work that you and others on the committee have done to try to get at Fannie and Freddie, very much the causes of monies not being traceable or accountable had a root in that collapse that we all suffer from till this day. So, Mr. Chairman, thank you for the continued work, and I might note the presence of the House chaplain, who has seen fit to begin looking at the work of our committee, and perhaps that is the best sign of all. Yield back.
Thank you, Mr. Chairman, and Father, we ask for your prayers. And today we have, members will have 7 days to submit opening statements for the record, and we'll now recognize the panel of witnesses. We have Mr. Eric Knoll, who's the Executive Vice President of NASDAQ OMX Group. We have Mr. Joseph McCann, Executive Vice President and co-head of U.S. Listings and Cash Execution, and is testifying on behalf of NYSE Euronext. It is the policy of this committee that all witnesses be sworn in before they testify. If you'll please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth? All right. Let the record reflect the witnesses answered in the affirmative. Thank you. You may be seated. And with that, we'll recognize you each for a period of 5 minutes to summarize your opening statements. We have the simple light system. Red means go. No, of course not. Traditional light system, it's green means go, yellow means whoa up and sort of wrap it up, and yellow means whoa up, and then red, yeah, go as fast as you can, says Mr. Quigley. So at the yellow light, that means you have 30 seconds to wrap it up. And we'll now begin, Mr. Knoll.
Thank you, Chair. And Ranking Member Quigley. At NASDAQ OMX, we believe the challenges that we face in today's equity markets around liquidity and capital formation can be addressed by actions in 4 areas. 1, addressing market structure weaknesses and their concurrent effect on price discovery. 2, changing the lack of regulatory focus on rules and trading venues that would assist in the development of vibrant small company growth. 3, removing regulatory barriers to small and mid-cap companies that impede the IPO process and raise the costs of being public for those companies. And finally, not directly related to liquidity and capital formation, but to assist companies in building their businesses, the development of an H-1B and other immigration reforms to assist those companies in their internal hiring and growth plans. We believe that addressing these issues is critical for generating job creation and growth in the U.S. economy. Today's U.S. markets, the engine of economic growth, are increasingly fragmented and volatile. Liquidity in U.S. stocks is dispersed across 13 exchanges and over 40 other execution venues. Nearly 1/3 of public company stocks trade 40 to 50% of their volume away from the organized exchanges. In the past 2 years, the percentage of U.S. market share traded in those systems that do not post their bids and offers rose from 20% to over 30%. Many retail and core investor orders are executed away from those primary exchanges. While we identify market fragmentation as the source of some of the issues in regard to capital formation in the U.S., there have been many benefits of that fragmentation. They have reduced investor costs and have improved execution qualities in already listed securities. However, the unintended consequences of that market fragmentation have been a lack of liquidity and price discovery in listed securities outside of the top 100 traded names, and a disturbing absence of market attention paid to small growth companies by all market participants, including exchanges. Although recent market volatility has led to a slight movement towards exchange markets, trading in shares of public companies on these private trading systems accounts for more volume than on NASDAQ and the NYSE combined. Price discovery and available transparent liquidity are essential parts of vibrant market systems. Just as our markets continue to evolve and adapt, so must the regulatory structure of our markets. We support the development of a consolidated audit trail with real-time market surveillance and new regulatory tools to help regulators keep pace with technology advances and other changes in the markets. Between 2003 and 2007, the amount of capital raised by private equity funds increased by 300%. Issuing private equity allows companies to avoid disclosure and governance obligations created to protect investors. 2008 and 2009 were the worst years for IPOs since at least 1980. In 2009, there were just 12 venture-backed IPOs raising $1.6 billion and 270 acquisitions with disclosed deals totaling $14.1 billion. U.S. stock listings are on the decline. In 1995, there were around 8,000 U.S. listings. Today, there are around 5,000. Meanwhile, the number of listings on non-U.S. exchanges has increased from around 23,000 in 1995 to over 40,000 today. Exchange listings help companies raise capital both directly and indirectly. In addition to selling shares, exchange trading establishes a fair, transparent price for a company. A company that has a clear price and many potential buyers will attract further investors and lenders to help them fund growth. It is well recognized that companies that do not trade on exchanges are valued at a discount. Financial experts, the U.S. IRS, the SEC, and courts recognize that discounts for lack of marketability range from 30% to as high as 75%. A company valued 30% or more below its true value will not be able to invest, grow, or create jobs as quickly. Plainly stated, the higher the number of bidders for an asset, the higher the sales price. Academic research has estimated that between 2000 and 2005, a $50 billion drop in foreign IPOs on U.S. markets cost the U.S. $3.3 billion in lost annual trading-related revenues for U.S. brokers. These revenue losses mean jobs in financial services and related industries and are moving from the U.S. to foreign markets. In any free market society, the #1 source of job creation is entrepreneurship. Canada, the United Kingdom, and Sweden have successful venture markets with significant numbers of listed companies and substantial capital raising success. These markets list hundreds of small companies that create jobs at a fast rate. Venture market companies regularly grow, then graduate to the main markets in those countries. The U.S. has no equivalent U.S.-supported and organized venture market. NASDAQ OMX has received approval to create such a market on the former Boston Stock Exchange. The companies listed on BX will be smaller companies, and the availability of the BX market will facilitate their ability to raise capital to continue and expand their business, creating jobs and supporting the U.S. economy. In conclusion, we'd also like to quickly address the regulatory barriers for IPOs. We ask that the SEC be open to market-based solutions to create competitive solutions to market problems. We also think that Sarbanes-Oxley reform is critical as we go forward to help small companies go public and remove some of the impediments to their ability to go public. Thank you for inviting me to testify, and I look forward to responding to your questions.
Mr. McCain. Chairman McHenry, Ranking Member Quigley, and members of the subcommittee, I want to thank you for inviting NYSE Euronext to discuss whether new and smaller public companies suffer from liquidity issues as a result of our current market structure, and whether the current structure contributes to a lower level of IPOs. I intend to focus my attention on three main topics. First, I'll focus on the importance of liquidity for companies with small market capitalizations and a proposal we believe may help small cap issuers. Secondly, I'll discuss liquidity fragmentation in the marketplace. And lastly, I'll address the subcommittee's question regarding liquidity payments to market makers. Before I jump into the points previously outlined, I'd like to give some background about smaller issuers and why it's important to focus on this segment of the market. Small and medium-sized enterprises, so-called SMEs, are the backbone of the American economy, and in previous economic downturns, entrepreneurs and small businesses have been the main source of job creation. In fact, 18 of the 30 Dow Jones Industrial Average companies were founded during economic downturns. However, in order to enable SMEs to reach their full potential, capital must be easily accessible. In that effort, NYSE Euronext has been vocal in its support for Congress to adopt legislation to increase the threshold for Regulation A offerings, as well as to adopt a larger exemption for SMEs from Sarbanes-Oxley Section 404B. Each of these and other efforts are with a keen eye toward not only capital formation, but also job creation, which increases significantly as companies move through the capital formation process. To echo some of the remarks by Chairman McHenry at the beginning, over 90% of jobs in a company are created after a company goes public. There is one reason that liquidity is so vital for new and smaller issuers. Companies with small capitalizations consistently raise two concerns about going public as it relates to market structure. First, will there be sufficient liquidity in my stock? And secondly, will I have sufficient analyst coverage? As the Securities and Exchange Commission recognized in its 2010 concept release on equity market structure, small cap stocks can and often do trade differently than large cap stocks. In particular, we've observed less liquidity at the national best bid and offer for small cap stocks, which we believe may be hampered by too narrow of a spread increment of a penny. While narrower spreads are generally a very positive result for investors, we believe that a penny minimum tick size may counterintuitively reduce the amount of liquidity at the best price, thus resulting in smaller quoted sizes for in thinner markets. Accordingly, NYSE Euronext has advocated that a market-wide pilot with wider spread increments for less liquid securities could be a worthwhile exercise. During the pilot period, market participants and the Commission can review data to determine whether the impact is providing added investor benefits to less liquid securities. This could help increase the appetite for research coverage, which declined after the global research settlement and should be combined with a separate review of the restrictions around IPO communications. Liquidity concerns for emerging growth companies transcend the public markets, with volumes fragmented across multiple exchange and non-exchange venues. While we believe that competition has been a positive factor for the marketplace, we've noted that the level of off-exchange participation in less liquid stocks is frequently above average. However, price discovery is dependent on interaction among a diverse set of market participants. In this vein, we've recently filed for approval of our newly created retail liquidity program. This program will allow for superior execution prices for retail investors and encourage additional price competition for retail orders from liquidity providers. And we believe this program could help consolidate and potentially increase the liquidity in less liquid securities. Finally, the committee requested comment regarding what, if any, additional incentives could be adopted to incent market makers to post liquidity in less liquid stocks, including the allowance of issuers to pay market makers to provide liquidity directly. The committee has discussed the creation of a program where small cap companies could enter into agreements directly with broker-dealers. NYSE Euronext believes the idea discussed warrants further review from both FINRA and the SEC, and it's a topic that we've been separately pursuing. We'd note, to echo Chairman McHenry's comments, that this is a process that exists in Europe and has shown beneficial effects on the liquidity of smaller issuers. In closing, NYSE Euronext believes that Congress and the appropriate regulatory authorities should work together with the industry to identify appropriate steps that can be taken to increase the level of liquidity for smaller public companies. Even if only on a pilot basis, trying new things will allow the market to determine which approaches could have the greatest impact on increasing the level of liquidity in liquid stocks. Jobs are the #1 issue facing our nation, and although only part of a broader solution, we believe that adopting some of the approaches previously outlined will have a positive impact in reversing some of the negative trends we've recently seen. Thank you for the opportunity to present.
Certainly appreciate your testimony. This is it's very helpful and instructive. I want to begin this way. You know, there's a lot of discussion about what our public markets actually do, and it's missed on a lot of individual Americans what the public markets are really all about. And so I want to ask you, what net benefit do you provide to society through your exchange, through the public markets? And I'll just begin there, Mr. Knoll.
Well, I think we provide several. The first one is what I would call the ability to discover prices for assets. So if a key tool for investors of all types, retail and institutional, is to understand the real value of an asset that they're investing in and the willingness to risk their own capital by investing in that, understanding the true price of that underlying asset is critical. And so the ability of exchanges to discover that price for all investors on a fair and transparent way where everyone has access to that same price is critical for the determination of the underlying value of those assets. Linked to that price discovery formation is what I would call liquidity discovery. So just as important as discovering the price is the size at which I can transact at. And so exchanges perform a valuable function in gathering together all of the available buying and selling interest that's out there so that investors not only can discover price, but they can discover the size in which they can transact at that price. Ultimately, that price discovery and that liquidity discovery enables companies not yet public to help themselves determine how they will be valued when they become public, and provide a framework and a platform in which they can, in fact, bring their asset forward, attract investor interest, and see the liquidity in that investor interest develop, and therefore raise prices to create jobs and grow their own businesses. So if I were to summarize, those are the big three that I think add value from the exchange side.
I'll echo Mr. Knoll's comments. I'll also add that one of the primary purposes of an exchange are to match companies who are looking to raise capital in a public venue with potential investors who may look to invest in that company, help it grow and expand. Clearly, companies that do want to go public or want to raise capital have a number of different options that they can pursue. In order to do that, they can look to private investors and do a private capital raise. They can look to be acquired either through a traditional M&A transaction or through a private equity or venture capital type transaction, or they can choose to raise capital in a public format. Obviously, the theme of this panel is talking about why companies may choose to go one of those other routes instead of going the public company route, and that's obviously a complex question, but I would view that last piece as being the primary responsibility of a public market.
And with IPOs, it's about accessing capital in order to grow your business, and it's a choice that you described, Mr. McCain, between the various options. You know, many small businesses put it on a credit card to get started or get a loan. Probably not right now. They probably put it on their credit card more so. And then once they grow, they can get to the stature by which they can go to the public markets to access capital to more fully grow their business and take leaps and bounds. It also provides investors, individual small mom and pop investors, the average American, to access this type of equity side, upside benefit of companies going public. Well, I think it's important to begin there because a lot of discussion about financial service products right now aren't related right back to what their net benefit is. It isn't a benefit as a product. It's a benefit of price discovery and accessing capital to grow a business. So I wanted to begin there. I would hope that we could come back for other rounds of questions, but with that, I'd like to recognize Mr. Quigley for 5 minutes.
Thank you, Mr. Chairman. It's interesting the Chairman brought this up to the 30,000-foot level. Sometimes we have questions that are more specific. I guess I'd like to ask a specific question, but then get back to a larger 30,000-foot perspective. My initial question had to do with Mr. McCain. In your written testimony, I think the quote is, although the FINRA rules adopted in 1997 prohibit any direct or indirect payment by an issuer to a market maker, NYSE Euronext believes the idea discussed may warrant further review by both FINRA and the SEC, and it's a topic that we have been pursuing. Obvious concerns, but because the rule in the first place dealt with manipulation, it dealt with the potential that executives of a company are incentivized to have their stock valued very high, so it creates an opportunity for inappropriate activities. That question, and I'd like you to both address it, really gets to me the core of the issue here with what we try to do here. Put yourself in our place. What we're really dealing with for yourselves and for ourselves is faith and trust, both with the American public and with potential investors. Investors they have to have faith that there won't be a manipulation, but also the larger issue of giving you the opportunities to do what needs to happen to create jobs when the American public still has a gaping hole in faith and trust. Can you address that as a larger issue?
Sure. It's a very good point, and we echo your concerns about ensuring that investors have full faith and confidence in our public markets. And part of why my words were chosen carefully is because I don't think it is a very straightforward topic, and there are different sides to the same equation. The reason the restriction was originally put in place was to avoid exactly the point that the Congressman raised, that there is a conflict inherent in a situation where a company itself is paying a liquidity provider to make a market in the stock. And so it's part of why, while we believe it may be a worthwhile discussion and experiment to try, it would need to be done in a way where there was sufficient disclosure and discussion around the conflict itself and whether it could be addressed. When I specifically stated that it's an avenue that we've been pursuing separately, part of our thought is, and where we've been looking at this as an opportunity, is specifically in the ETF market. And while that's not a topic of this committee, it's relevant because with ETF products, which are generally linked back to the underlying securities, there's less opportunity for manipulation because there is an arbitrage between the ETF price and the stock price. My point is that one avenue to try is an experiment specifically with ETFs with this type of a program to see if it actually helps with liquidity in those names. And that could then give more support and documentation as to whether it would be worth trying in the public markets also. So it could be done in a two-step process to try and minimize the conflict that you raised, Congressman.
Thank you, Congressman. Like the New York Stock Exchange, this has been an issue that we've been paying attention to for a while. In NASDAQ OMX in Stockholm operates a market called True North, which is a venture market in which market makers do receive payments from issuers. And we've seen some great success in that platform in developing liquidity in the Nordic markets. Here in the U.S., I think our concerns are echoed by you and by the New York Stock Exchange, that the ability to create conflict or have conflicts in this area is something that we have to be very careful about. We are proposing, not unlike the New York Stock Exchange, to come forward with our own set of rules around this kind of process. One would be for our BX venture market, which we would create a structure by which the exchange in an open and transparent way would collect payments from issuers and then use them to provide to market makers to provide liquidity. And so that we are preparing a rule filing now to submit to the SEC that would allow us to do that. I think it brings two very good benefits to us by doing that. One, not only to us but to the marketplaces. One is that it is a rule set that would be transparently argued, debated, and approved by the SEC, and therefore monitored by them on an ongoing basis. And the rules would be available and open to everyone to see and to participate in. And then I think it would address a problem that this committee's identified, which is that there is a lack of liquidity in these small cap stocks. And I think it's fair to say and important to say that market makers will respond to economic incentives. So passing a rule that says market makers need to make markets in small cap stocks won't add any more liquidity. What will add liquidity to them is creating economic incentives for them to benefit by providing liquidity, and we think that this program will do that. Likewise, on the ETF side, NASDAQ is preparing a rule filing to do the same thing as well, which is to stimulate market maker interest in less active, less interesting ETFs, or not less interesting, but less followed ETFs to help stimulate liquidity in those as well. And I agree with Mr. McCain that in both cases, I think that these are valuable experiments for the Commission to try.
Mr. Genta, the Vice Chair of the committee, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you both for coming here today. In a series of subcommittee hearings that we've been having over the last several weeks, we've been focusing a lot on how to create access to a stronger job market in this country. Obviously, the country is concerned about that primarily, and it has a dramatic effect on just about everything we do, nationally and internationally. My focus is more narrow in scope, and I want to talk a little bit about the IPO market. I want to talk a little bit about the decline of IPOs that we've seen recently in this country, and I wanted to ask you both to focus a little bit on, number one, why you think we've had a decline in IPOs, where those IPOs are being listed, and what the negative effect of that is in terms of job creation here in America. And Mr. McCain, if you want to begin.
Sure. Thank you for the question, and I will borrow from a report that was recently issued, which the committee may or may not have seen, but it's a series of recommendations from the IPO task force, which tried to tackle this issue and did, I think, do a good job of generating some data to support the issue that we're being discussed. And what seems to be the prevailing trend around the decline in IPOs is specifically concentrated in the smaller part of the market, so the sub $50 million type companies. Mm-hmm. And it does not appear that those companies are not being created or that they're actually going public on other venues. What appears to be the trend is that they're choosing to, when they get to a size where they're at a decision point about what the next step is for them to proceed, is they're choosing increasingly to go through a private M&A type transaction, either being acquired by a larger firm or a private equity type firm, instead of going the route of the public market. And I would say that's been the very broad trend over the last 20 years, where the first decade of the last 20 years was marked by a very high level of capital issuance by those smaller companies, and the last decade of the last 20 years has been marked by more of these private M&A transactions. Obviously, it's an important question from a job creation standpoint, because as we noted earlier, much of the job creation that does happen in a company's life cycle occurs after they go public, when they do have access to all these additional funds to expand their business and to hire and to go into new business lines. And so the question as to why companies are choosing that private route instead of the public route is an important one. It's also, I believe, a complex one with a number of different dynamics occurring simultaneously. To paint one side of the equation, clearly the private equity and private capital part of the market has become a lot stronger in the last decade. And so some of what we're seeing could just be the evolution of that part of the market and an increasing ability to have another option other than going public. But at the same time, I think it's hard for us to ignore the fact that the costs of going public and the oversight of being a public company, especially for a smaller $50 to $100 million type company, has been increased significantly over the course of the last few years. Obviously, it's a balancing act post Sarbanes-Oxley and other types of reforms to make sure that there's confidence in our companies and willingness of investors to know that the companies that they'd be putting money in is safe. But at the same time, it does call into question whether there are things that we can do to make it easier, less costly, especially for the first few years of a company being public, to be able to go public more easily.
I want to get to Mr. Knoll, but just one final question. So would you agree with the statement that an M&A transaction rather than an IPO is missing an opportunity for job creation?
I don't want to overgeneralize too much, but I would agree that in a lot of M&A transactions, the focus tends to be on synergy opportunities as opposed to expansion opportunities, and that's an overgeneralization. It's not always true, but I do generally agree.
Generally speaking.
Yes.
Okay. Yes. Mr. Knoll, can you just give maybe add to what Mr. McCain?
Sure.
McCain's
Following
comments?
up on Mr. McCain's comments about M&A, I think one of the which I generally would agree with. I think one of the issues that we're facing as an exchange and as an economy is that when that becomes increasingly the only avenue, it creates limitations on the way companies can grow their business, the way they can ask for capital, and the way they can use that capital to grow their businesses. And so it isn't so much that M&A represents a bad way for companies to grow their business, or private equity is a bad way for companies to grow their, quite to the contrary. Those are all valid and very good ways to grow businesses. But as the IPO window for those businesses has closed, it removes some of the optionality for what companies can do in a way that is most ideal for them. And so that we become very worried about that and making sure that we're developing that market for that small cap company. You had asked earlier as well, where are companies going? So the small companies are clearly going to the private markets. Foreign issuers who traditionally had come to the U.S. to raise capital are choosing not to list here. And a lot of that is compliance with our Sarbanes-Oxley rules, which may create additional costs for them that they would not like to face. I think the costs of market fragmentation are expensive for them. It's an interesting day when Manchester United, a very large UK sports team, chooses to list its stock on Singapore, and quite frankly never considered a U.S. listing. And 20 years ago, they would have come to the U.S. almost by default. And so how we think about those issues, I think, is important as we go forward. So I think it's critical that we try to clear up the IPO calendar and the IPO structure for those small cap companies and those foreign issuers.
I see my time has expired. I appreciate the chairman's indulgence.
All right, thank you. And now we'll begin a second round. So the bid-ask spreads, have tightened, but out of that, order flow's gone way up. I mean, the volume's gone way up. That's correct, right? So what does that do for exchange revenue? Does that mean exchange revenue goes up with the order flow, or is it, Mr. McCain?
Sure. I would make 2 points. One is that there's been two separate dynamics going on in the industry. One is that clearly as bid-ask spreads have compressed, we've seen an increase in volume. But I would also highlight the point that in that same period of time, part of why those two trends happened is because there has been increasingly aggressive competition in the space, and the prices that exchanges and other venues have charged has also declined commensurate or even in excess of the spread decline. So I'll just highlight that even though there is higher volume, because of those trends, we're actually, frankly, making less money than we were in the prior periods. But it also leads to a second point, which is more specific to the small and mid-cap part of the market. A lot of the spread compression and increased competition that we've seen has been in the very large liquid stocks, where you've seen a lot of algorithmic type trading, high frequency type trading, which tends to narrow the spread, make it very cheap and efficient and fast for large cap stocks to trade. The unfortunate reality is that those same trends haven't occurred in the small and mid cap part of the market. Those stocks don't have sufficient liquidity for the high frequency type automated traders to traffic in those names, and as a result, you've not seen a commensurate level of volume or liquidity or spread compression that you've seen in some of the large cap names, and that's part of why we've suggested the experiment with perhaps wider spreads, as counterintuitive as that is, for those names.
Okay, so there's less revenue off of a new listing based on competition.
Correct.
Okay, but order flow has gone way up. The volume's gone way up. So part of that is with the spreads compressing, but the order flow going up. In those terms, spread compression, order flow going up, have they offset each other roughly?
I think probably roughly.
Roughly? Is that how you see it with NASDAQ?
I do, though I would note that volumes have actually come down in the last year, year and a half. And I think it's, while I think there's a great deal of truth to the statement that tighter spreads and lower costs have driven volumes up, I think one of the things to remember about volumes and participation in the marketplace, it's ultimately about confidence in the market and its market structure. and it's also about the ability of investors to transact in effective ways. And so we have seen some of that confidence impaired. Quite frankly, we've seen volumes come down, and some of that confidence isn't necessarily in exchanges or in exchange systems, but in the strength of the U.S. economy. And so we have seen much higher volume days 2 or 3 years ago than we have in the last year. So while there certainly is a link between low costs and higher volumes, it isn't the only driver for volumes. So I think that's an important thing to know.
So order flow is more important than new listings, though. Is that fair to say? As a business concern, I mean.
Well, I think 2 things about new listings that are critical for us and why we're starting to pay a lot of attention to the sector is, one is this is where the new companies are going to come from. And we as exchanges, in particular at NASDAQ, if we can't get those companies to be public and listed on one of our platforms for trading, as they grow up to be big companies and very important companies in the U.S. economy, we won't be performing our function in the way that we hope to be performing.
So therefore your investment in what used to be the Boston Exchange?
Right.
Okay.
So the creation of the BX venture market, try to look at market maker structures to provide liquidity there, which is, for us, is a long-term investment in the development of new companies. Because ultimately we think that that's where the future growth is going to come from, and we need to participate in that.
Okay. So you get an IPO. Immediately, because of fragmentation, market fragmentation, liquidity fragmentation, you have a substantial amount of your order flow off your exchange, right? Am I correct? Okay.
Yes.
Okay.
Yes.
So what you do to incentivize liquidity instantly benefits these folks that are. It doesn't benefit you. It benefits this order flow off your exchanges. Is that correct? So this is part of the challenge, is what that incentive is for you actually benefits not your companies. I mean,
Yes.
To be clear, I mean, you've both accessed the public markets in a very unique way as an exchange. So you do have to be concerned about your revenue. So instantly, as a policymaker, I look at this and I'm trying to figure out, how to incentivize you. But instantly, how much of the order flow after an IPO goes off your exchange? Is it, Mr. McCain?
Yeah, it's roughly, in a given name, we'll have roughly 30% of the market share across our different venues, 35% of the market share on our exchange. And then the rest will be fragmented across other exchanges and non-exchange venues. To your point, a lot of the focus, and clearly we're self-interested in that argument also, but a lot of the focus is it's twofold. One is attracting as much liquidity to our market as possible, and secondly, it's creating as much liquidity in general in that name. Clearly that benefits us from a revenue standpoint, but I think the more important point is that to really take a particular company or their stock to the next level, it needs to be a name that institutional investors and long-term investors are comfortable investing in, and unless there's enough liquidity available, they're not going to be comfortable putting their funds into that particular company.
Mr. Knoll, and then I'll pass off to Mr. Quigley. So I've gone over my
thank
time.
You. Thank you, Chairman. So I think the competition between marketplaces has actually been very healthy. It's been very healthy for us as an institution. I think it's been healthy in many ways for the marketplace. And I agree with Mr. McCain that when we take a company public, we retain post-IPO about 30 to 35% of the volume in that name on an ongoing basis. But the competition between markets has actually helped us to innovate. In many ways, it created the success of NASDAQ over the long term. And so as we go forward and we start to think about what we need to do for small cap companies, it's not the competition with other venues that I worry about. It's the ultimate market structure that we put in place that will enhance the development of getting those companies to be public. I think the competition between venues is a very healthy one. It inspires us to do better. It inspires us to work harder. And I think for us to compete for volume and for us to compete for success in this marketplace is not a bad thing. I think that's going to spur us to do a better job of it going forward, and we would fully expect to win more than our fair share of that business back in that kind of a competitive environment. So I'm less worried about that kind of functionality than I am in the overarching market structure that would enhance small companies being able to go public.
Thank you. Mr. Quigley.
Thank you, Mr. Chairman. So we want to help. We recognize that this is about striking a balance to protect investors and the public and creating jobs. And Mr. Knoll, you started off on a bit of a pessimistic note, which I appreciate and respect. But give me a little glimmer here. I'm reading quotes from Renaissance Capital about 2010 being not so bad, that it was the first year since 2007 where the number of IPOs was back in the triple-digit range, and obviously it's not just the number that matters, it's their performance. But they also quote say IPOs didn't have just a good year in terms of numbers. The performance was strong too. The average U.S. IPO rose 25%, the best returns for IPOs since 2006. Do you agree with those numbers? See a trend or some hope along the future?
Well, I think clearly there has been a lot of successes in this past year. So on NASDAQ, of course, we look at Groupon and Zillow, which have recently listed on our marketplace and have done very well for investors. And in many ways, those are both household names that many investors are very familiar with. And so we have seen some repair in the IPO market from the depths of the financial crisis in 2008 and 2009. I think what concerns us less is whether the household names go public, right, who have grown, they're big, they have significant revenues, they have a share of mind in the investing public because of their success off exchange. What concerns us much more than that is we're not seeing support either for going public or two in the aftermarket for small companies who may not be as big as Groupon or may not be as big as Zillow to go public. So small biotech companies, small green energy companies who need to access capital and are struggling to find ways to do so. And so while there has certainly been a very positive change from the depths of the financial crisis to today in terms of IPOs, I still think that there's issues around those smallest cap companies and their ability to access capital.
Mr. McCain.
I would echo that comment. There has been a fairly robust IPO market in 2011. We've had a number of very large companies go public with us this year, Kinder Morgan, LinkedIn, Pandora. The issue, as Mr. Knoll said, is we are seeing much of that IPO activity concentrated with the large cap stocks and not with some of the mid and small cap stocks that we've seen historically.
But you alluded earlier to rules and concerns and issues that you were. I look forward to the continued discussion. I mean, the devil's in the details. So on an ongoing basis, we would encourage and appreciate your participation. Thank you, and I yield back.
The Vice Chair, Mr. Genta, for 5 minutes.
Thank you, Mr. Chairman. Mr. Knoll, I want to touch a little bit on what the Chairman was talking about and relate it to market structure. I guess I wonder, there's obviously competition between New York Stock Exchange and NASDAQ, but I guess I would start to ask the question this way. Who do you really see as your competition? I mean, I have great concern about market structure. I have great concern about the willingness of an IPO to occur on an exchange here in America. And I see a lot of these either M&As or listing overseas. Now, I see that as a fundamental long-term problem economically, not just for job creation, but for the potential and future investor. So we're talking about the benefits that one exchange would have over the other. But I worry that we're focusing too much on not you, but NASDAQ focusing too much on New York Stock Exchange, or New York Stock Exchange focusing on NASDAQ, and the benefits that one would get from services provided by the other, when I think the longer term and the larger problem is is a different competitor. So how do you see? Do you see the person sitting next to you as the competitor, or do you see some other exchange as the real competitor?
Well, clearly, Mr. McCain and I are colleagues and respect one another's ability tremendously, and yes, the New York Stock Exchange is a competitor of ours. But I think in fairness to where we really view competition is not just the New York Stock Exchange. In many ways, it is a global competition. So we compete with other marketplaces, other venues around the world. We also compete domestically. Not necessarily against the New York Stock Exchange, but alternatives for capital raising. And what I mean by that is when a company is looking to raise capital or grow its business, who are we competing with for that capital raise? Oftentimes it's with a private equity firm or some other alternative for raising capital. So yes, there is a vigorous competition for listings between the New York Stock Exchange and NASDAQ in the United States on a daily basis. But our competition is much broader than that on the listing side. On the trading side, it's even more robust than that. So clearly the New York Stock Exchange is one of our key competitors on providing a transaction platform, but we compete with transaction platforms around 13 other exchanges in the U.S. and 40 plus other trading venues, plus broker-dealers, plus foreign trading there. And so we view our competition on the trading side in a much more robust way as well. And essentially what we're hoping to do is respond to that competition is with innovation, things like the BX venture market and other things that we've done that will help us gain trading volume and share by doing a better job. And so our competition is a very broad competition, not a very specific one.
So how much are you concerned about the services that you provide benefiting a competitor?
I'm much less concerned about the services we provide benefiting the New York Stock Exchange or quite frankly any of our other exchanges. I view that as a state of being. We have a competitive environment out there and we have to respond to it by being better at our jobs. I do think though that one of the critical things that we're going to have to think about in terms of going forward is how do we provide liquidity, whether it's on NASDAQ, whether it's in the marketplace as a whole for these small cap companies. And so ultimately the market structure that has to be put into place is one that identifies that, not necessarily benefiting one market over another market.
What about off-exchange equity trading venues?
They exist. They provide value in many ways. So I think it's important that off-exchange trading venues continue to exist where they can do things that we can't do. Or they do things for customers that we have been unable to do. One of those is provide price improvement. One of those is to retain the ability to not have a large institutional order exposed to the marketplace. In other words, solve the information leakage problem. And ultimately, if they are contributing to price discovery, we have less issues with those things. I think where we do have issues is when we, as an exchange, are barred or otherwise restricted in our ability to compete in that marketplace because of SEC rules or other strictures that allow us or prevent us from competing effectively, and where those off-exchange venues are not contributing to a fair, transparent market and to price discovery.
So we have liquidity is dispersed, you say, over 13 different exchanges, and are you suggesting that is part of the liquidity problem?
No, it's a fact. I mean, what I'm noting is in those large cap names, liquidity scattered across 13 venues and 40 plus more off exchange. Those venues aren't trading small cap stocks, though. All of that liquidity, all that trading is taking place in what are essentially 100 very large names.
Okay, so if we want to grow the IPO market, should we be focusing on the small cap?
I think large companies, to a large extent, take care of themselves. Right. Where we need help is in that small and mid cap sector, and I think that's where we should focus on our market structure rules. Is how do we help those companies provide get liquidity, get research analyst coverage, and access to public markets.
That's where I think we ought to be focusing as well. So, through either a further line of questioning or additional future testimony, I'd be very interested to know what you feel the 2 or 3, 4 things that we can be doing to enhance that and augment that, because I think that is the direct nexus to job creation, whether it's in my home state of New Hampshire or anywhere in the country, but that is going to greatly benefit a local economy and I think the national economy. Thank you again, Mr. Chairman, for allowing me to extend my remarks.
I certainly appreciate it, and with the panel's indulgence, I'd like to go for another round, if that's all right. And to be honest with you, at this point, I started with the broad concept. Why do the public markets matter, right? I mean, to the point where most, your hardworking American looks at the public markets and thinks it doesn't have relevance to them. But it does, because it brings in capital to the United States, lowers the cost of capital in a competitive marketplace, makes capital more available and cheaper. I mean, that's sort of the ideal here. And it also means that, as opposed to private equity, that the hardworking American can put their money, whether it's $500 or $5,000 or $5 million, into the public markets and actually have proper price discovery, and at the same time, hopefully, over a period of decades, a nice return. But we're also talking about this challenge with small cap companies. So one of the challenges is liquidity, and so to discuss this, we begin with liquidity. What can you do as an exchange legally now to provide these small cap companies a measure of liquidity? Mr. McCain?
Sure.
Mr. Noel?
The primary mechanism that we as an exchange can use to incentivize liquidity is we've got various market maker programs on our exchange where we incentivize those liquidity providers to meet certain liquidity and quoting obligations. In exchange for that, we share a portion of the economics that we obtain through our transaction services. We've actually skewed some of those payments to the point where in some of the small cap names we're actually sharing almost more or all or more of the revenue that we are able to get in the transaction part of the business, just to try and incentivize further liquidity creation. And
the transaction part of the business,
meaning
is that the IPO, or is that the
meaning the trading piece? So
trading piece, ongoing?
Yeah, so we're able to use some of the revenue that we generate from the trading part of the business, and we use that to subsidize the market making community. One of the circular issues is that there's in some of these names, we're paying out all the revenue that we generate, and it's not necessarily enough to help get the liquidity to where we would like it to be.
Mm-hmm.
That's part of the reason for why we think the experiment of also letting issuers compensate market makers could help, because in some circumstances we're already paying all the revenue we have, because most of that is on a per transaction basis and these issues don't trade very frequently. It doesn't generate enough revenue to necessarily incentivize the liquidity providers.
Okay, so company goes through the whole process, going to the public markets. When they go to the public markets, oftentimes with their broker-dealer, they'll say, well, we want to have price support for the first month or 6 months or year or whatever that may be, right?
Correct.
So the broker-dealer provides a price support.
Correct. That's generally very specific around the IPO time, when there's Reg M exemptions and there's permitted activities that broker-dealers can use to, but there isn't necessarily an economic relationship going forward after that specific IPO event.
Okay, sure. But the reason why I bring that up is structurally there is a level of support that currently exists in the marketplace legally.
Correct.
Okay. So what are the possible solutions? Let's just talk about some of the solutions.
On the liquidity side, again, there's the idea of creating a different spread environment for small and mid-cap stocks. It's hard to know in a perfect world whether that would actually work or not. It's why we've advocated perhaps a controlled experiment. But one of the dynamics of a penny spread environment, which again has been very beneficial in the large cap stocks, is that when you have stocks that will trade with a wider spread of a nickel or a dime, something along those lines, but there's the ability for another market participant to come into the marketplace and better whatever price is there by just a penny, so not significantly narrowing the spread, but just narrowing it by a small increment. We think that by actually holding wider spreads in discrete intervals of a nickel or a dime, it could actually incentivize people to put more liquidity into the market because they'll be more confident that someone won't step in front of their bid or their offer with a de minimis amount. Again, it wouldn't be the only fix to the issue that we're talking about. I think anything we do has to be part of a comprehensive package.
So that actually, on its face, that increases the inefficiency.
That's why it's very counterintuitive, but in a way, we think it could actually improve efficiency, and that's why we're not saying it should be nickels or dimes with the very liquid stocks where a penny works very well. The natural spread if the natural spread for a stock is a penny, then it makes sense that the stock should trade at a penny. What we're more targeting is where the natural spread for a stock looks like it's more in the 5-cent or 10-cent range, but you're still allowing very small increments to be quoted in the marketplace, and whether that's actually efficient, even though it appears efficient.
Okay, so is that spread differential based purely on volume?
I think there's a number of factors, and it would need to be debated by the industry and the SEC what the right framework would be, but I think it would be some combination of volume, market cap, perhaps the price of the stock. I think there's a number of factors that would go into determining the right intervals.
And so could you create conceptually, could you create a system by which the competition would determine what that spread is? So as the volume goes up and the market cap goes up, the spread could tighten.
Correct. And I think it would need to be a collaborative industry solution. Part of why we haven't done something like this on our own, and why we can't on our own, is because if we're the only ones quoting in different increments but everyone else is quoting in penny increments, it just doesn't work. It needs to be an industry-wide solution. When the SEC put their concept release out in early 2010, this was one of the items that they raised, and we had, in our comment letter, indicated that this would be a good market-wide experiment to help the trading in small and mid-cap stocks. But it would need to be an industry-wide solution. Mr.
Knoll, would you like to touch on some of these areas?
Sure. I think I'd go back to an early statement I made, which is, what's critical here is that market makers have to be incented in the right way to provide liquidity. So they will not do so at the risk of their own capital, where it's not economically viable for them. And so what's important is to create that viable platform for us to be able to incent market makers. Some of that may be tick sizes in making the spread more viable for them to provide liquidity there. Some of it may come from liquidity payments directly from issuers or through exchanges. And some of it, quite frankly, is what I would call a time and place advantage, which is under our current market construct, every market maker starts out evenly, and it's best price that wins, and oftentimes it's the first at the best price, of what we call a price-time allocation system. So for smaller cap stocks, what might be more important is creating a time and place advantage for market makers, rewarding them by providing liquidity in those small cap companies. So by ensuring that they get a larger piece of the trade, not necessarily because they were there first. So within that mix of ideas, I think there are many things that exchanges can do to provide liquidity in these small cap companies.
Okay, so you both mentioned the benefits of, you mentioned the positive nature of market fragmentation. What if you took these small cap companies and you were only the market? There was no market fragmentation. Walk me through that.
Well, if there was no market
fragmentation, is that objectionable to you, or is that positive to you? I mean,
well, I think the critical thing would to make sure that that would not be permanent. Right? I think there's a certain benefit for what I will call a runway period of time. So if you had a small cap listing on your venue and you had a runway to establish liquidity, incent market makers to create that liquidity and build the marketplace there, I think that could have some very positive effects. I think where it starts to become dangerous is if that looks like it could be a permanent state of being. And so where I think we would want to see the market go, if that was a market structure innovation that was developed to help concentrate liquidity in IPOs and small cap companies, we'd want to have some very clearly delineated lines around that whereby other venues could start to compete for that business as well. Because ultimately I think that competition is necessary. So if you want to give companies runways, I think that's an interesting idea and one that we'd be certainly willing to explore, but I'd want to see an end date for that.
Mr. McCain, do you want to touch on that? I'm not trying to create a bunch of controversy, but we're throwing out concepts on this problem, and
it's a very good question, and it's one that does get a significant amount of debate in the industry, obviously, given that there isn't a clear-cut solution. There's obviously a balancing act between having concentrated liquidity and the whole liquidity begets liquidity argument about having as much robust price discovery happening in one place versus the benefits of competition and having diverse competing venues also trying to generate liquidity and market share, et cetera. And the question is, where is the tipping point between the healthy level of fragmentation and when, if any, does it go too far? One of the factors that we highlighted is that while there's an average level of activity that happens, away from the primary market or away from exchanges, it tends to be much, much higher in the small and mid-cap stocks. There's a lot of reasons for that. It's not necessarily clear, but one reason is because the spreads are wider, so there's an increased incentive to trade those names proprietarily if firms can. Some of it is because a lot of those names tend to have a higher proportion of retail investors in them, so they tend to get traded away from the exchanges. One of the things that we've done, as I mentioned, is we've launched a program recently, which isn't in effect yet, but it's out for comment, to try and attract retail orders specifically to exchanges where we think in mid and small cap stocks it will be beneficial. Again, the theory there being that perhaps if we concentrate more liquidity together, especially in those small and mid-cap names, perhaps there could be a feedback loop in terms of also generating additional liquidity. It's unclear what the result will be, but again, we're just trying different things to get at the problem.
So you mentioned in the European market the ability to purchase liquidity support. Explain to us how that functions.
Sure. So right now in many European markets, including the ones we operate, private companies have the ability to contract with brokers to offer a certain amount of liquidity support for their stocks. In general, the academic research has shown that it is beneficial and it helps improve the spread and liquidity in a name. The one distinction is that those programs do exist in a very different market structure than the one we exist in, and especially the periods of time that have been studied in those academic studies tended to focus on more monopolistic type environments and
less
fragmented. And so the only point I'm raising is that I'm hesitant to draw a direct analogy, but think it's at least worth an experiment.
Worth
Trying,
seeing if it
works.
Correct. Okay. All right. Well, thank you for your indulgence, and now I recognize the Vice Chair, Mr. Ginta.
Thank you, Mr. Chairman. I want to go back a little bit to the competitive issue and how ultimately we ought to be providing flexibility and options for small cap companies. I guess I should be a little more specific in my line of questioning. The first question I would have is the services that you provide. I'll ask Mr. McCain first. The services that you provide, would you say that they help a competitor once a company is listed?
I do think there is a certain level of that because of the nature of our industry, where it is a very competitive market, and anything that we create can be generally replicated or copied by other venues. I don't think it's necessarily a bad thing in that there is a benefit to first mover advantage, but clearly it could be there's a certain negative result when everyone else ends up doing the same thing. Where I do think, though, but generally the competition that we're talking about, whether it's price competition or new product competition, even though it might not be as beneficial for us as venues, ultimately the consumer benefits from that. It generally will result in more product choice, or it will result in lower prices. Where I do think that competition becomes unhealthy or a problem is where it becomes regulatory competition, to use a different phrase. One of the things that we've advocated for is that all participants in the marketplace who are performing similar functions should be subject to similar regulation. And I think that also fits into a surveillance and oversight theme. One of the initiatives that the SEC has advocated is this creation of a consolidated audit trail. And what that will do is aggregate together all the activity in the marketplace and give a consolidated view of all the trading and all the activity that's happening, not just on exchanges but on other venues. And I think, that type of consolidation is very important, especially as it relates to people's confidence in the public markets.
What about the idea or the notion of a new issuer paying for their own services, or designating some of their funds for that specific service? I know earlier you said that you utilize the revenue that you gain for that to provide that service, but you also, I don't know if you said it, but I will assume it, that you don't have enough revenue. Therefore, should we be exploring the opportunity of allowing the new issuer?
Yes. So to link all those things together, everything you said is correct. We do share the revenue that we generate in incentivizing liquidity providers. One of the challenges with small and mid-cap stocks is that in a lot of cases we're paying everything that we make, and so supplementing that with a direct payment from the issuer is, we think, a worthwhile experiment. Clearly, there's issues that need to be tackled.
Yeah,
one of the things I said earlier is there's a conflict inherent in that relationship, and one of the things that we've explored and been pushing is that the ETF market, where you don't have that same conflict, but you do still have some of the liquidity concerns with newly created products, could be an area to conduct an experiment and see whether you get beneficial liquidity in some of the less liquid ETFs as a result of this type of program. And then, assuming we can document positive results, we could then try a second experiment with some stocks and see if it has the same effect.
And there's a number of ways that we could meet that objective that ensure the conflict of interest is mitigated.
Correct.
Talk to me a little bit about you mentioned the regulatory concerns. What are some of the regulatory issues that we should try to address?
One just general topic that has been discussed and is a frequent topic of the SEC's agenda, and one of the things that they're working on is around the level of disclosure for different activities and filings that have to be made. Clearly, exchanges have a very high level of public disclosure about our activities and how we handle orders and our pricing. And one of the topics is whether that level of disclosure should be applicable to all market participants. And there's valid reasons on both sides of the argument, but clearly from our standpoint, we think that a similar level of disclosure is warranted.
Okay. Thank you, Mr. Chairman.
Thank you. The discussion is about the consequences or potential negative consequences of this liquidity support. So, walking through this, if the liquidity support agreement required these following A couple of things, 4 things. The agreement is publicly disclosed. The liquidity provider does not provide hedging service to third parties. The liquidity provider does not trade on a proprietary basis of the issuer's security. And the liquidity provider does not reveal its trading strategy or of the planned transactions or to the issuer. You think that would be sufficient to counter the possible negative consequences?
I think that's definitely a good place to start. Frankly,
What are the additional things you would require?
There could be a public disclosure of the terms of the arrangement, and we could, through the exchange or through the SEC, there could be a mechanism to disclose exactly what's being done. There might be confidentiality concerns around that, so we could debate what level, but I think perhaps some additional public disclosure of certain terms could be helpful.
And duration,
what
some of the terms,
the obligations are, what the payment structure is.
Okay, Mr. Knoll.
I agree with Mr. McCain. I think those are very good places to start. A couple of areas to perhaps pay a little more attention to when you talk about proprietary trading. Clearly as a market maker, the market maker is going to be taking positions in the security. That's one of the things that providing liquidity means. So, very carefully
obviously
delineating what is a market maker position and what is market maker behavior from what is a speculative proprietary position.
No, that can't be too complicated. I mean, how many pages is the simple vocal rule? It's what, 300 pages?
I think we could burn a lot of brain cells trying to define that line. So I think those are the areas I think that I think we would have to spend some attention on. One possible area to look at, I think, as an addition there is what is the definition of market quality that you're looking for, and having that be a transparent part of this proposal, which is this is our expectation as a company for what we expect to see from supporting this kind of market maker support system, spreads of X% and depth of Y securities, and as part of that overall process, I think maybe a healthy area as well.
Okay. Interesting. This has been very helpful. I know we've touched on a number of things here. Global competition is certainly a concern, obviously, and you've both touched on that to some degree. And the importance of really bringing capital to the United States. I mean, that's really what our capital markets are about, is sort of being a sponge to bring in capital. Are there any things you want to add additionally, and just in this broad concept we're talking about, ideas, solutions, problems that we haven't touched on in this hearing? Mr. Knoll?
Yeah, we've touched on almost everything, but I do want to emphasize that I think the problem here is not just about liquidity and not just about market structure. There's clearly regulatory impediments for companies going public. You could group them most largely under what I'll call Sarbanes-Oxley, but there are more than those. And I think addressing those, I think, is also going to be critical to making this successful if we're going to improve the IPO market for small companies.
Do you want to talk about anything in particular with Sarbanes-Oxley?
Well, clearly the 404 restrictions and allowing that market cap companies that are exempt from that to be higher than it is today. We agree with the $1 billion mark that we've seen out there. And we think that that's something that I think would be very useful for companies as they go forward. Implementing perhaps a time or a grace period for companies after they go public may also be very beneficial. And then, we are very concerned about the new PCAOB requirement that companies change auditors as we go forward, because it feels to us in many ways like an unnecessary expense. One of the benefits of working with an auditor over time is that they know the company and they become very familiar with the way the company works, and so the costs of the audit actually go down. To have to switch auditors on a frequent basis to bring new auditors in essentially just creates a very expensive proposition for companies, and yet another reason why a company may not want to go public. So I think it's important that we think about those in this context as well.
Mr. McKay?
I'll echo what Mr. Knoll said and the point I made earlier, which is that any type of reform that we do needs to be part of, I think, a broader package. I don't think any market structure fixes in and of themselves are going to necessarily fix the problem. I'll point again to the IPO task force report, which I thought did a very good job of coming up with very discrete, concrete recommendations that are, reasonably implementable as a path forward for increasing potentially research coverage, making it easier for companies to go public, some perhaps palatable regulatory relief that could help loosen up some of the trends that we've been seeing.
What about securities class action lawsuit reform?
As a non-lawyer,
I like this.
it's
I
probably
like the stare off here.
it's something that we could certainly get back to you with an opinion on, but obviously I think the
That
cost.
is a creative answer. Let me ask this in a different way, because it wasn't even open. It was just an open-ended statement, really. Do securities class action lawsuits, and the structure and form and the payment and the expense, do they disincentivize the public markets?
What I would say very broadly is that I believe that when companies are evaluating their different future options, that there is a perception of a cost of being public. Some of that being the oversight of quarterly earnings and complying with the different rules. Some of it is, to your point, Chairman, subjecting yourself to potential lawsuits from investors, et cetera. I think that goes into the evaluation and the equation, whether conscious or subconscious, about whether people's best path forward is a public or a private one. So I think anything that potentially increases the cost of going public is negative.
Mr. Knoll?
I would agree with Mr. McCain there. We would have to also get back to you with our opinion about securities litigation reform. I do want to emphasize, though, that one of the critical things that exchange markets do, and by being transparent markets, is create a set of rules by which all companies have to abide by, both in their listing standards and in the trading of those rules. And so keeping investor protection in the front of our minds is also important. So to the extent that anything that supports investor protection in this process is something that we wouldn't want to give up as we go forward.
Okay. Well, on that area of agreement that you'll both get back to us, I certainly appreciate your willingness to have the conversation here this morning. This is the roadblocks to the public markets and the impact that has on job creation. I mean, this is not something that we touched on, but obviously when companies are able to go to the public markets, access capital, they're able to greatly expand their workforce and what they're able to do in terms of offering their product or their service. And so having a vibrant public markets goes right along with vibrant labor markets in modern societies and around the world historically. But I appreciate your willingness to have the conversation about these ideas, about these concerns, potential solutions, but also the current struggles that we're facing right now. I appreciate your ability to have that conversation and sort of engage in a broader range of subject matters this morning. We very much appreciate it as policymakers here, those watching from their offices, and those of us that are trying to craft legislation to free up capital formation in this country. This is very helpful. Thank you for your time. With that, you'll each have, if I may, I've got my final script here. You'll have 7 days to add additional comments to the record, as will members. With that, this meeting stands adjourned.